Hi there, welcome to Kneppy Invest. Let's talk ARB, a four-wheel drive accessory company founded in the 1970s because there was an untapped market. I believe, if I remember correctly, this company was formed because back in those days, if you want to go into the interior of Australia, you had to build your own four-wheel drive accessories. So all the accessories were homemade. So there was definitely a market for it. And a gentleman by the name Anthony Ron Brown saw the opportunity and built up ARB. And if you just remember that name I just said, Anthony Ron Brown. ARB. Yes, that's where this company's name comes from. It's the initials of the founder of the company. This is a highly thought of company on the ASX, and you'll be able to see that when we look at the valuation of this company. I actually do like ARB. I like the potential of this company. They are expanding throughout the world as well. They have revenue in Thailand, UK, United States, but by far the biggest market for this company is in Australia. The company has quite a few stores around Australia, so they get revenue through their aftermarket division. They also have an international exports division plus an OEM. In fact, revenue growth in the Australian aftermarket actually grew up 2.6% from last year, but this company had declines in revenue in exports and OEM. Profit was actually down to inflationary pressures, weaker Australian dollar, and a few other reasons. Now on to financial year 23 results for ARB. Revenue down a little bit, 3.4% from last year, 671.2 million. Now, in isolation, that might be a little bit of a concern, but we'll look at the revenue history over the past 10 years for this company. And in my opinion, this is not a concern. The trajectory is still positive in terms of revenue growth for this company. Profit down 27.5%. Again, I don't think that's a big concern at 88.5 million. And the main reason behind that is because of really good performance in the past 2 years. And you might be able to argue that the profit is now trending towards the average of or growth for this company over the past 10 years. Nice gross margins, 53.1%. There is one slight concern when it does come to the close gross margins. And again, I'll talk a little bit more about that when we look at the financial history of this company over the past 10 years. Operating cash flow, 90.4 million. I was a little bit surprised about the capital expenditure, about $40 million in that. And that's why free cash flow is significantly lower than the operating cash flow at 49.9 million. And a pleasant surprise, this company has actually net cash. So very little, if any, debt at all, and $45 million of net cash. And that is a major positive in my opinion. So I am looking at debt levels for all companies, particularly where we are right now with higher interest rates. Only 82.2 million shares on issue. That means at a share price of $32.34. In fact, I am recording this video just after market has begun on the 6th of December. And I'm just going to have a look at what the share price is right now. And the share price is $32.53. So not much change from $32.34. But at $32.34, with 82.2 million shares on issue, the market cap of this company is $2.7 billion. Equity up from 555 million to 607 million. Return on equity and return on invested capital are probably where you want it to be. We don't want to see those numbers any lower than, say, 10, but 14.6 return on equity, 12.9 return on invested capital. Now, this is just 1 year. What I like to do is look at return on equity, return on invested capital over a 10-year period. And for our ARB Corporation, most of the years, if not all the years, are above 10. Dividend yield, 2.1%. So not a big yield for this company. And one of the reasons behind that is because the market is selling this company or buying this company at a premium. And the market has a high opinion of this company. And you're able to see the high opinion the market has of this company just by looking at the valuation. And what I mean by valuation, I mean valuation metrics. So here are the valuation metrics, starting with the PE ratio, 30.5. A little bit surprised to see it that high. I think even Lovisa is not quite that high. And I do, in my opinion, this is my opinion, I think Lovisa has better growth opportunities. And I think that PE ratio of 30.5 really exemplifies the premium this company has because the market has high expectations for this company and believes you have to pay or buy shares in this company at a premium. Price to book ratio 4.4, even the EV to operating cash flow at 29.3. Now, one of the things one of the numbers, sort of range of numbers I look for in terms of good value is EV to operating cash flow between 6 and 10, 29.3 for ARB Corporation. Of course, every single company has to be judged differently when it comes to EV to operating cash flow, but 29.3 is quite high, which means, again, there is pretty lofty expectations when it comes to ARB Corporation. I also did a reverse DCF. What would the growth have to be in operating cash flow, so not free cash flow, operating cash flow, to justify the current valuation? So I got 18.8% per year, which is quite high. And I'm wondering if the market expects really good international expansion over the next decade. One thing I like to do for all companies, particularly if they have many divisions, if they have operations throughout the world, is a disaggregation of revenue. Sometimes they will show the disaggregation of revenue in their presentation. If not, you can go to the notes section of their financial report, and they usually have it. Not all the time, but usually. And this is a disaggregation of ARB Corporation's revenue by region: Australasia, USA, Thailand, Middle East, Europe, and UK, and then there's another one called elimination. So we won't focus on eliminations, but by far, the majority of this company's revenue is through Australasia. In fact, 538 million of their 688 million, USA at 80.9 million, Thailand 9.6 million, and Middle East, Europe, and UK at 60 million. Also included here are the 2022 numbers, so we can see which regions have performed quite well over the past year. So that includes Australasia and Middle East, Europe, and UK, all up, but USA down from 100 million to 80.9 million, and Thailand down slightly from 9.76 million to 9.62 million. And I'm pretty sure, I did read somewhere, the company did go into an explanation of why the American revenue was actually down for the year. So have a look at the presentation, have a look at some of the commentary if you want further explanation on why the United States revenue down for the year. Now, one of the things I always look at when I'm researching a company is revenue growth. I highly favor revenue per share growth over just revenue growth, but sometimes for a company like ARB Corporation that does not issue many shares for capital raisings, just looking at revenue growth is good enough. The other thing I've included here is gross margins, and preferably I like to see gross margins, if not climbing, at least being stable. So the first thing, when you look at revenue, it is up. This is a really good indication of a growing company, and really good indication if they can maintain this over the next 5 to 10 years, that ARB Corporation more than likely will be a bigger company in the future. In fact, revenue has grown from nearly $300 million in 2014 to $674.5 million in 2023. Now, if you look between 2014 and 2020, revenue was climbing at a nice gradual rate, and then it popped up in 2021, another nice growth year in 2022. Now, nice little pull, but not nice, but a little pullback in 2023. And this is why I'm not concerned about this little pullback in revenue in the past year, because of the high growth in revenue in 2021, 2022. Of more concern is the gross margins. So gross margins have been dropping. In fact, the gross margins for financial year 23 were the lowest over the past 10 years. Really nice gross margins between 2014 and 2019, although you might be able to argue that gross margins were dropping. So that's probably my main concern when it comes to this company, is just the decreasing gross margins. And there could be reasons why the gross margins have been dropping. Maybe they're getting more of their revenue from lower gross margins activities. Maybe OEM or exports is lower gross margins. So maybe if you want more information on that, have a look to see or understand why gross margins have been falling. But still, I prefer gross margins to be at least steady, if not growing through time. Now, even though I mentioned the P/E ratio of this company is 30, just looking at the P/E ratio in isolation at one point in time for a company is probably a fool's game. You have to compare the P/E ratio or any valuation metric ratio of a company to its normal historical range. So this is a P/E ratio history for ARB going back to 2014. And as soon as I saw this, I realized that there has always been a premium attached to ARB Corporation. In fact, the lowest PE ratio we have seen during the past 10 years for this company is around about 17.5. And that was not long ago. That was in the last half of 2022, sort of the last 6 months of 2022, when the low of the PE ratio for this company was 17.5. And the high in the PE ratio has been 45. And that was just after COVID-19 financial panic. And you'll be able to see that period, how much interest there was in this company just by looking at the chart. But normally the PE ratio for this company hovers between about 25 and 35. So right now it's at 30, which is sort of the normal range. So I probably would say, just based off this particular PE ratio history, that ARB is fairly valued. Of course, ARB is a dividend-paying company, and one of the things I like to look at for all companies is a dividend history. Some people just like to buy a company because they have a high dividend yield in one particular year, the year they invested, and then don't really understand that sometimes that dividend can actually go down through time. So their dividend yield actually decreases. So the way I like to invest is I like to invest those companies that have putting effort into growing the company. And if they can grow the company through time, more than likely the dividend will grow through time, which means the dividend yield on your initial capital will grow through time. That is the best way, in my opinion, to build wealth. Now, the only reason I'll buy Telstra shares or even the bank shares is if I was just looking for income in a particular year. So I can understand why retirees might be looking at those sort of companies. But for investors like me, who are still a fair few years away from retirement, I would focus on companies that are able to grow their dividends. And ARB has definitely done that over the past 10 years. In fact, if you go back to 2013, they had 28 cents of dividends. Now it's at 62. So the dividends have almost doubled in the past 10 years. Now to the chart for ARB Corporation. I'm just going to look at and focus on the weekly chart. That's the only reason, because in my opinion, this is, if not a high quality company, it's definitely close to being a high quality company. And I think the market is saying this is a high quality company just by looking at the valuation metrics. And usually if you want to buy a high quality company, you have to pay a little bit of a premium. And for ARB, you do have to pay a little bit of a premium. Now, when you look at this chart, the main thing you see is the share price has been climbing through time. So this is exactly what you see for a high or in a high quality company, an increasing share price through time. Now, at certain stages through the last 10 years, we have seen the share price accelerate, and we definitely saw that from the bottom of the COVID-19 financial panic all the way to the start of 2022. And in that period, the share price of this company went from $12 to $54. I think that was, we could probably definitely say there was a little bit too much froth in this company, particularly when the share price got as high as 54 and the P ratio of this company was as high as, what was it, 45. That was there was a little bit too much excitement in the market around that time. And then, of course, the share price pulled back, which is what we usually see when a company does become overvalued. And I think it's safe to say ARB Corporation was definitely overvalued during the last part of 2021. And the share price pulled back from $54 all the way down to 26. So the share price more than halved over about a 6-month period. But when the share price did get down to $26 in the last half of 2022, that was a time to think about taking a position in this company. And in fact, the share price really struggled to get below 26. It tried 3 times over about a 3 to 6 month period. So it seems like $26 was a really good support level for this company. And right now, at a share price of, say, $32, it's not much higher than $26. So again, I think just based off this chart, I wouldn't necessarily say ARB Corporation is overvalued, definitely not undervalued. So again, fairly valued. The next 5 companies I planned on doing in this particular series include Johns Lyng Group, which I'll be doing next. PolyNovo, really looking forward to doing a little bit of research on that company. The valuation market cap of PolyNovo is quite high. Anyway, DGL, another company I'm excited to do some research on, a chemical company that whose share price has been significantly hit over the past few years. So maybe there is value in that company. I am a shareholder of LaserBond, just like Johns Lyng Group, so always excited to do videos on companies I own. And I have not yet decided, or probably the better word is I have not yet drawn a name from my hat in regards to the fifth company I'll be doing. So I'll be doing that choosing in the next few days. So watch out for the next video on John's Ling Group. That's all I have for this look at financial year 23 results for ARB Corporation. I'd love to hear your thoughts on this company, particularly if you're a shareholder. And in my opinion, this is a high quality company. And I think the market believes this is a high quality company. So you do have to pay a premium. In fact, I probably might even argue that this is one of the highest quality retail companies on the ASX. And that is just by looking at the PE ratio and what the market is willing to pay for this company. So if you have any thoughts, if you are a shareholder, I'd love to hear your thoughts. So leave those in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who's qualified and can speak to your own financial needs. That's it for the video. Have a good day. Bye.